Okay, so there's this huge shift happening on Wall Street right now, and it's flying a little bit under the radar. We're seeing private equity giants make this massive strategic push into one of the most traditional and, let's be honest, kind of unflashy corners of finance, the insurance industry.
So you got to ask, right? Why? Why are these huge firms, the Apollos and the Blackstones of the world, suddenly so interested in what most people would call boring insurance companies? It seems totally counterintuitive, but the answer, well, it pulls back the curtain on a brilliant and maybe even a little risky new financial playbook.
And let's be clear, this isn't just some minor trend we're talking about. People in the know are calling this one of the most significant strategic shifts in the entire investment world since the 2008 financial crisis. So yeah, if you want to understand where the big money is headed next, you need to understand this. So what's the secret ingredient? What are they really after? Well, it all comes down to a concept that is seriously shaking things up. It's called permanent capital. See, this isn't just about buying a company for its quarterly profits. No, it's about getting their hands on the company's entire balance sheet. This giant, stable pool of cash that can be used for years, maybe even decades to come. So what exactly is permanent capital? Well, think about a normal private equity fund. It's on a clock, right? It has a deadline. It has to invest money and then return it to its investors, usually within about 10 years. But insurance money? That's a whole different ballgame. The premiums that people pay create this incredibly stable, long-term pile of cash that doesn't have an expiration date. It's capital you don't have to give back. All right, now this is where it gets really interesting. These firms aren't just buying insurance companies to run them the same old way. No, no. They are completely flipping the playbook on its head. Here's the core of it. Traditionally, insurance companies played it super safe. They'd take your premiums and invest them in slow and steady things, like government bonds. Super low risk, low return. The new owners, though, they're taking that same money and yanking it out of the slow lane and merging it right into the fast lane by reinvesting it in their own higher-yielding private assets like private credit or real estate. They're basically turning a defensive shield into an offensive weapon. When you really boil it down, the model is beautifully simple. Step 1, buy an insurance company. Step 2, get access to its huge pile of cash from premiums. And finally, step 3, funnel that capital right back into your own private funds. It becomes this powerful self-feeding machine. And what this does is it creates this really powerful, symbiotic relationship. On the surface at least, it's designed to be a win-win for both the investment firm and the insurance company that it now owns. So let's look at who wins here. For the investment firm, it's the holy grail, a steady, reliable stream of capital without having to do those endless, exhausting fundraising roadshows. And for the insurance company, well, it gets access to those higher yield investments. In a world of super low interest rates, that's absolutely crucial for them to earn enough to actually pay out future claims to their policyholders. But, and you knew there was a but coming, this cozy relationship comes with a twist. This really innovative strategy is also raising some serious red flags for regulators, who are starting to see a potential dark side to this whole story. The fact is, this isn't flying under the radar. Regulators in both the US and in Europe are sitting up and paying very close attention. They're getting worried that this new model, while really profitable, might be pumping a whole new level of risk into the financial system. Their concerns pretty much boil down to two big issues. First up is transparency. See, because these private assets aren't traded on a public market, valuing them can be tricky. It's really hard for anyone on the outside to know if the insurer is actually on solid financial ground. And second, there's this problem called a liquidity mismatch. What happens if a whole bunch of policyholders want their money back at the same time? Well, the insurer might be forced to sell those illiquid private assets at fire sale prices, which could create a massive spiraling loss. And that right there is the real fear. This isn't just about one company getting into trouble. Because these firms are so huge and so interconnected with everything else, a major problem at one of them could spread like a virus, potentially creating a systemic risk for the entire economy. So, that leaves us with the big question that really defines this whole debate. What are we looking at here? Is this a brilliant and innovative evolution, the future of finance, a smarter way to put capital to work? Or is it a disaster just waiting to happen, concentrating risk in the shadows and setting the stage for the next big crisis? Only time will tell.